What is going on, Bitcoin Bulletin fam? Get ready, because the crypto universe is absolutely buzzing, and you are locked into the most important updates you need to know right now. The market is moving at lightning speed, and if you're not plugged in, you're missing out on the action. We've got game-changing moves from major players, shifting market dynamics, and critical insights that could shape your strategy. Don't blink, because today's news is unmissable. We're diving deep into a massive acquisition that's pushing the boundaries of corporate involvement. We're exploring the historical patterns that could signal a significant shift for digital assets, and uncovering the strategic plays that are defining the future of institutional adoption. Plus, we've got a deep dive into how these corporate treasury strategies are creating both opportunities and challenges for everyone in the space. You absolutely do not want to miss this episode. Make sure you hit that like button, subscribe, and ring that notification bell so you never miss a beat. A blockbuster acquisition confirmed. In a move that's sending ripples across the financial world, a prominent Bitcoin firm has just executed a monumental purchase, adding a staggering 4,048 BTC to its already substantial treasury. This acquisition, valued at an impressive $449.3 million, brings the firm's total Bitcoin holdings to a colossal 636,505 BTC, now worth approximately $46.95 billion. The average price point for this latest batch of Bitcoin was around $110,981, underscoring a continued, aggressive accumulation strategy. This significant investment was primarily financed through a series of at-the-market stock offerings, cleverly utilizing both common stock and perpetual preferred shares, demonstrating a sophisticated approach to capital management and asset acquisition. The firm has been actively raising capital, with recent filings indicating strong funding from these stock issuances, some of which are specifically designed to remain well-capitalized for further Bitcoin acquisitions, showcasing a clear commitment to expanding their digital asset reserves. This strategic accumulation aligns perfectly with a growing trend of major corporations integrating Bitcoin into their balance sheets as a primary treasury reserve asset. Not only is this firm making waves, but other significant entities are also bolstering their Bitcoin reserves, with reports of companies like Ming-Xiang Group and KindlyMD making substantial purchases in the hundreds of millions of dollars, signaling a broader institutional embrace of Bitcoin. What's particularly noteworthy is the relative stability of Bitcoin's price, hovering around the $111,000 mark, even amidst these massive corporate buy-ins. Analysts interpret this stability as a strong indicator of the market's increasing depth and its capacity to absorb large-scale institutional demand without triggering significant price volatility. The firm's leadership has repeatedly expressed a bullish outlook, viewing the current price levels as an opportune moment for long-term investment, essentially calling it a sale in the grand scheme of Bitcoin's potential. Furthermore, the company is on the cusp of a potential milestone, qualifying for inclusion in the prestigious S&P 500 index. This qualification, based on robust financial performance and market capitalization, could see it become the first Bitcoin treasury-focused company to be listed on this major benchmark index. The decision is anticipated in early September, potentially marking a pivotal moment for Bitcoin's acceptance within mainstream financial ecosystems. The implications of this potential S&P 500 inclusion are vast, suggesting a new era of institutional legitimization for digital assets. The market is watching closely as this firm continues to pioneer corporate Bitcoin adoption, setting a precedent for how other businesses might navigate the evolving landscape of digital asset treasuries and strategic investment. The strategic capital-raising maneuvers and the ongoing accumulation of Bitcoin are not just corporate actions. They are indicators of a fundamental shift in how global businesses view and integrate digital assets into their long-term financial planning, potentially unlocking new avenues for yield generation and value appreciation. But what does this historic corporate buying spree mean for the average investor? Stay tuned as we break down the market impact and explore the potential for significant price movements ahead. The September slump signal. As September dawns, a familiar, yet unsettling, pattern is emerging for Bitcoin traders, with historical data suggesting a potential for a significant monthly downturn. For years, September has been notoriously challenging for the flagship cryptocurrency, with 9 out of the last 14 Septembers registering declines. On average, Bitcoin has seen a monthly loss of approximately 12% during this period, a historical trend that looms large as the market navigates current conditions. This year, the sentiment appears to be a continuation of that trend, with Bitcoin opening the month near its weakest levels in nearly 2 months, trading around the $110,000 mark. Consequently, the total cryptocurrency market capitalization has also dipped, hitting a 3-week low of $3.74 trillion. While Bitcoin prices have remained relatively flat in the past 24 hours, other major cryptocurrencies are showing mixed performance, with Solana's SOL leading gains at 4%, XRP up 1%, and Cardano's ADA seeing a 1.5% rise. Traders and analysts are pointing to a confluence of factors contributing to this cautious outlook. Macroeconomic uncertainties continue to cast a shadow, coupled with what appears to be fragile market sentiment and thinning trading volumes. This combination leaves little room for error as the market heads into what has historically been the toughest month on the calendar for digital assets. On the technical analysis front, the charts are not offering much comfort. Experts have noted that the broader market capitalization chart continues to record a series of lower lows, which is a classic signal of a downward trend. Specifically, Bitcoin's inability to maintain support at the $112,000 level has led to warnings of further declines, with a potential drop towards the $105,000 area, a level that has previously acted as crucial support before the psychological $100,000 barrier. The prevailing mood in the market is further reflected in the crypto fear and greed index, which has slipped back towards 40, indicating rising nerves and a move away from greed, a sentiment not seen since April. This historical data paints a stark picture. In 2017, Bitcoin experienced an almost 8% drop in September, despite the broader bull run that year. In 2019, the token lost nearly 14% during the month, preceding a period of sideways consolidation. Even more recently, September 2021 and 2022 both witnessed steep drawdowns, reinforcing the notion that liquidity drains and macroeconomic jitters often coincide with the end of summer. Adding to these concerns are the recent flows into spot Bitcoin ETFs in the US after consistent inflows throughout August. These ETFs recorded net outflows totaling $440 million last week. In contrast, Ether ETFs, a newer product, saw inflows exceeding $1 billion, which some interpret as a potential rotation of capital rather than an overall expansion. Data from CryptoQuant reveals that spot ETFs have now accumulated over 1.3 million BTC, representing nearly 6% of the total supply, rivaling the market share of the largest exchanges. The primary risk identified is the potential for key support levels to break before any significant macroeconomic relief materializes. Upcoming economic data, such as the non-farm payrolls report, is expected to show a slowdown in the U.S. labor market, which could strengthen the case for a Federal Reserve rate cut. Such a move could potentially reignite a risk-on sentiment, but until then, traders are actively hedging against downside risks, with options data showing a pronounced demand for put options, signaling a firmly bearish skew. With historical patterns pointing to potential volatility, how should investors position themselves? Next, we'll explore the strategic plays that are shaping institutional adoption and what it means for the future. Institutional accumulation, the new frontier. In the rapidly evolving landscape of digital finance, the strategic integration of Bitcoin into corporate treasuries is no longer a fringe concept, but a burgeoning trend that is reshaping investment paradigms. This shift represents a significant case study in how major corporations are not only accumulating digital assets, but also exploring innovative ways to generate yield from these holdings, fundamentally altering the traditional approach to treasury management. At its core, this strategy involves companies like the one discussed earlier, which has aggressively expanded its Bitcoin reserves. By purchasing substantial amounts of BTC, These firms are signaling a profound belief in Bitcoin's long-term value proposition as a store of value and a potential hedge against inflation. The sheer scale of these acquisitions, often financed through sophisticated capital market strategies such as at-the-market equity offerings, demonstrates a mature and calculated approach to integrating a novel asset class. This is not simply about holding Bitcoin, it's about leveraging it. Companies are exploring avenues to generate yield on their Bitcoin holdings, potentially through lending, staking, or other decentralized finance, DeFi protocols, although the specifics often remain proprietary. This move towards yield generation from digital assets marks a critical evolution, moving beyond the passive accumulation phase to an active management strategy designed to enhance returns on corporate balance sheets. The implications for traditional finance are substantial. As more corporations embrace Bitcoin and explore yield-generating strategies, they are effectively bridging the gap between legacy financial systems and the emerging digital asset economy. This integration not only legitimizes Bitcoin as a serious asset class, but also creates new financial products and services tailored to institutional needs. Furthermore, the focus on Bitcoin as a treasury asset is influencing wider market dynamics. It's driving demand for custody solutions, insurance, and regulatory clarity, all of which are essential for broader institutional adoption. The success of these early adopters is also serving as a powerful blueprint for other companies considering similar strategies. They are demonstrating that with careful planning, robust risk management, and strategic financing, it is possible to significantly increase Bitcoin exposure while maintaining financial stability and exploring new revenue streams. The narrative is shifting from if companies will adopt Bitcoin to how they can best leverage it. This strategic accumulation and the subsequent exploration of yield generation are not merely financial tactics. They are indicative of a fundamental reevaluation of what constitutes a valuable reserve asset in the 21st century. The long-term impact could be a significant reallocation of capital towards digital assets, driven by institutional players seeking diversification, inflation protection, and new avenues for financial growth. The ongoing developments in this space are crucial for understanding the future trajectory of both Bitcoin and the broader financial markets, as institutional adoption continues to mature and innovate. As institutions double down on Bitcoin, what are the broader market implications for investors? We'll unpack the dual nature of corporate Bitcoin holdings next, the opportunities and the risks. Corporate Bitcoin holdings, a double-edged sword. The increasing adoption of Bitcoin as a corporate treasury asset presents a fascinating dichotomy, acting as both a powerful catalyst for market growth and a potential source of volatility for investors. On one hand, the strategic accumulation of Bitcoin by corporations signifies a growing institutional acceptance and confidence in the digital asset's long-term value. Firms are actively acquiring significant amounts of BTC, often funded through innovative financial mechanisms like stock offerings, demonstrating a commitment to diversifying their balance sheets and seeking potential inflation hedges. This corporate demand injects substantial capital into the market, driving up liquidity and potentially stabilizing prices, especially during periods of broader economic uncertainty. The involvement of major players can lend an air of legitimacy and maturity to the cryptocurrency space, attracting further investment and paving the way for wider adoption. Companies are not just buying, they are integrating Bitcoin into their core financial strategies, which can lead to increased efficiency and new avenues for value creation. This trend also fosters innovation in financial services, pushing the development of sophisticated custody solutions, derivatives, and other products tailored to institutional needs. However, this growing reliance on Bitcoin by corporations also introduces a double-edged sword for markets and investors. When these companies hold large amounts of Bitcoin, their financial health and strategic decisions can have a disproportionate impact on the broader market. For instance, if a major corporate holder decides to sell a significant portion of its Bitcoin holdings due to shifting market conditions, regulatory changes, or internal financial pressures, it could lead to sharp price declines. This concentration of ownership can create systemic risks, making the market more susceptible to the actions of a few key players. Furthermore, the volatility inherent in Bitcoin, while potentially attractive for high-risk investors, can be a significant concern for traditional corporations and their shareholders. If the price of Bitcoin experiences a sharp downturn, it could negatively impact a company's financial performance, potentially leading to write-downs and affecting stock prices. This creates a feedback loop where corporate actions influence the market, and market movements, in turn, influence corporate decisions. Investors need to carefully consider how this corporate involvement affects their own investment strategies. While institutional adoption is generally seen as a positive long-term development, the concentration of Bitcoin holdings among a few large entities introduces a new layer of complexity and risk. It means that market analysis must now account for corporate treasury strategies, capital raising activities, and potential sell-offs, in addition to the usual macroeconomic factors and retail investor sentiment. The trend of corporate Bitcoin holdings is a powerful indicator of the evolving financial landscape, but it requires a nuanced understanding of both the opportunities it presents and the potential risks it entails for the stability and predictability of the cryptocurrency market. So, what does this institutional embrace mean for the average investor's portfolio? We'll wrap it all up with a quick recap and your essential call to action. And that's a wrap on today's essential updates. We saw a massive Bitcoin acquisition by a major firm, historical data pointing to potential September volatility, and a deep dive into how institutional adoption is reshaping the crypto landscape, creating both opportunities and risks. Don't miss out on any future developments. Make sure you smash that like button, subscribe to Bitcoin Bulletin for all your crypto news needs, ring that notification bell so you're always in the loop, and share your thoughts in the comments below. Follow us on all social media platforms to stay connected. We'll see you in the next one.